Hi, good afternoon. This is the Cordant Wealth Market Update for Thursday, April 23rd. I hope you're all doing well and staying healthy right now. Today in this market update, we want to hit a few things. So one, just a recap of where the markets are so far year to date, and then also hit what returns are needed to recover to the previous highs. Also want to review what the markets have priced in so far in the downturn. Then we're going to turn to what we're watching. So again, hit some of the numbers around the virus and how that's spreading and some of the numbers around the economy. And then lastly, finish up with a question that we're getting, which is what's going on with oil. It's been in the news and we're going to take a look at that as well. So let's get into it. On the market front, year to date, on the S&P 500, obviously still down, but really this breaks into two components here. So the sell-off from February 19th through March 20th was down about 34%. Since then, we've bounced back about 26% on the S&P 500, and that's as of yesterday. So we have seen a bit of a recovery, and these are U.S. large cap stocks. Just a kind of a quick refresher here. We've looked at this slide before here, but in total, down 34%. That compares historically right at basically an average bear market drop. And after a bear market drop, question is, what do markets tend to do? And 1 year, 3 year, 5 years, whatever time period you're looking at, the returns tend to be pretty strong after the markets have bottomed historically. One question, though, is what returns will it take to get back to those previous highs that we hit on February 19th? So what we're looking at here are just two things. So one, the bars in the green are from that 34% drop, what kind of a return would it take over different time periods, 1 year through 10 years, to get that back to that previous high? So in 1 year, if we were to recover back to the previous high in 1 year, it would be a 51% gain to get that back. Now, we've already seen some of that. We basically bounced half of that back already, which we saw 26% bounce. So we've already done half of that. The other bars in gray here are as of where we were at market close yesterday, what would it take? So like I said, we've already recovered part of this. It takes another 20% up from here to get back to the previous highs. If we are to, we don't recover that all in this year, what kind of annualized return would it take over 2 years, 3 years, etc., to get back? And you can see, the longer you go, the lower that annualized return is to get back to the prior high. But I think important thing to note here is, if you're looking at 2 years, basically we need roughly a 10% annualized return over the next 2 years to get back to the prior high. That's pretty much in line with historical average returns for just an equity portfolio. Now, again, this isn't a balanced portfolio with stocks and bonds like all of our clients would have, but just in terms of looking at the equity markets, what does it take to get back? And right at the average return over the next 2 years gets us back to prior highs. If it's 3 years, it's even less to get back. So just some context around how long might it take, and sometimes it can seem to think, hey, we're never going to recover the previous highs, but the returns necessary to get back aren't astronomical by any means. Other thing to look at here, other question we're getting here is what exactly have the equity markets priced in? At one point we were down this 33, 34%, depending on which market you're looking at. And ran across a piece of research by the Mann Group out of the UK here recently, and they tried to kind of decompose what the markets are pricing in, both equity markets and fixed income markets. And the conclusion they came to is on the equity markets, assuming prices were fair going in, that they estimated that 33% drop, what the market is pricing in is earnings or cash flow or profits, however you want to look at that, they would fall to zero immediately, and then it would take 7 years to recover back to the prior level. And that's what the market is pricing in. They're using a very simple discounted cash flow model, and obviously there's a lot more going on than that. But just at a very kind of summary level, that's what their calculations say the market's pricing in. So again, the point of this is that yes, the economic data is coming out. It's going to be bad. GDP numbers, unemployment numbers, it's bad, but a lot of this is already priced in. And to the extent that we recover, faster, there might be some upside to the markets based on how drastic some of these scenarios that the market's already pricing in. Same thing would go on the fixed income markets, and probably even more extreme scenarios have been priced in there. So they looked at both high yield bonds. So think of things that are below investment grade, more risky companies that are have to borrow at a higher rate, and then investment grade companies. So these are more stable. Think of Intel, Nike, companies like that would fall into the investment grade category. On the high yield side, their estimate is that the market's pricing in a 40% expected default rate. That compares to really the other two major recessions that we've had over the last 100 years. The Great Depression, which had a 32% default rate, and the global financial crisis, which had a 14% default rate. So in the high yield market anyway, the market's pricing in some very drastic scenarios. On the investment grade front, basically they come to the conclusion the market's pricing in about a 7 or 11% cumulative default over 7 years. That compares to 3.6% in 39 and 1% in the global financial crisis. So again, all these markets, equity markets, high yield markets, investment grade markets, have bounced back from the lows, but at one point they were pricing in some pretty drastic scenarios. And the conclusion that they come to is really most of the really bad scenarios have already been priced in, and any surprises from here would likely be to the upside, to the extent that default rates or earnings aren't impacted as much as is priced in. It's actually upside to prices versus further downside to prices, was the conclusion they came to. So obviously this is one piece of research, but I thought it was interesting that they tried to decompose what was already priced in. That's it on the market side. Couple things to highlight here in terms of what we're watching. So again, just update the numbers on the virus and how that's spreading, and then take a look at some different economic forecasts that are coming out right now. So on the health side, updated this chart to show 4 countries. I took off South Korea and updated that with Sweden, who seems to be pursuing more of this herd immunity kind of approach. And then some of the, obviously still looking at the US, and then looking at Germany and Italy in Europe, and the numbers there. So what you see in the U.S. is kind of a flattening of the curve. 1 day of uptick, which puts the 7-day moving average moving up a little bit, but more or less flattening, versus in Germany and Italy, a pretty drastic downward slope. It'll be interesting to continue to watch Germany as they start to reopen the economy. And then Sweden, I think, is interesting because they've taken a different approach, a less severe lockdown approach, and the numbers have stayed basically flat. And be interesting to see as the United States starts to reopen, what these numbers look like. Other way to look at this is how rapidly is it spreading. The cases doubling every day over here to every 10 days over here, and again, South Korea being kind of the benchmark that a lot of people are shooting for. You see Germany and some of the European countries trending towards 5 days. In the U.S., we're kind of between 3 and 5 days, and this curve is going in the right direction. Other thing paying attention to here is just the geographic. Obviously, the United States is a large country. The geographic distribution of cases and how it's spreading. So again, epicenter remains on the East Coast, primarily New York and New Jersey, with obviously some of the other states seeing a lot of number of cases as well on the East Coast. On the West Coast, not as much. Oregon still 2,000 cases, which is great. Washington State 12,000 and 36,000 in California. Again, it'll be interesting to continue to watch this as different parts of the country reopen at different times, how the cases spread, how the numbers spread or not over time. On the economic side, couple things here. So GDP forecasts over time. So I think the key thing here is, again, some pretty bad scenarios are being priced in or being forecast right now, and there is a very wide spread in terms of the forecasts that are out there. So both in terms of quarter to quarter. So here, economists are expecting, this is kind of consensus economists out there, based on a CNBC poll. Economists are predicting a 30% drop on average for GDP next quarter, which is, this is annualized change, but it's still an extremely large drop with a very rapid recovery in the Q3 of this year. Obviously, this is a very big spread quarter to quarter, but also within each quarter, the best economists and the worst economists in terms of their forecast, there's a pretty wide discrepancy here. So again, a lot of dispersion in the forecast, but these are the averages. Other thing to note here is, again, on average, economists are calling for a 4.2 decline in GDP for the year. That compares basically to the decline in GDP that we saw in the Great Recession from Q4 of 2007 through the second quarter of 2009. So again, in terms of what's being priced into the markets, there is a very sharp contraction that's already being priced in, and it's showing up in the GDP forecast. Another way to look at this, a couple questions that the Wall Street Journal puts out there to economists in their survey. These are from the beginning of the month, but they're asking kind of when does the recovery start? And so again, most people, like we could see, most economists, like we could see on the prior chart, are looking at Q3 or Q4 for the economy to be out of recession and start the recovery. And then in terms of the shape, which, if you paid attention to the news, there's kind of an alphabet soup of what shape will the recovery be. You've got W, V, U, L, and others out there. But most economists, again, there seems to be consensus around a V, which would be a more rapid recovery, a sharp decline with a pretty rapid recovery, or a U shape, which means a decline with a more a longer period before we get that recovery. So think, a longer, wider bottom. So again, that the reason to look at this is it helps provide some clarity around what the markets are pricing in, what are the expectations. The way the markets work, those tend to get priced in pretty quickly, and if the news is better, so if almost half of the economists out there are predicting a U shape, and if we end up with a V shape, there's upside there. Obviously, if things are worse, then that would be the scenario where there's further downside. But it seems like there's a lot of this negative news that's already priced in, and so to the extent that we see a lot of negative news still coming out, which we will, we're seeing record numbers of unemployment. The unemployment rate numbers are going to go up. The GDP numbers that are coming out are going to be bad. We're into earnings seasons, and companies' earnings are going to be bad. But again, remember, a lot of this stuff is already priced in, and whether it's the Man Group with their research on earnings and what's priced in there, or just in terms of what we're looking at GDP, a lot of this stuff is already baked into the prices where we are today. Okay, last thing here, and speaking of prices, a question we're getting is what's going on with oil. If you've been paying attention to the news, you saw that the May contracts here in the U.S. for oil, for a barrel of oil, was going for up to negative $40 at one point. And so, how can that be? What's going on with that? What is that forecast for the economy going forward? So the first thing I think we have to understand is, two things. One is just how these futures contracts work, and then the other thing is fundamentally it's more of a supply and demand issue than it is necessarily what oil is forecasting for the future economy going forward. So first, in terms of how contracts work, the way they settle is if you own, so the contract that went negative was the May contract, you have to take delivery, meaning if you own the contract on the day it expires, you have to actually take possession or find somewhere to store this barrel of oil. So imagine somebody shows up at your house and offers to give you all the gasoline you're going to use in your car for the rest of the year, for the rest of 2 years. You're clearly going to need that gasoline at some point. Now, in today's world, less than you did previously, but that gasoline has value. However, you don't have anywhere to store it at your house for the rest of the year. And so if somebody made you take delivery of that gasoline, chances are you're going to end up paying somebody to take that off your hands. And that's kind of what happened here. So what you see in the blue line is the production of oil across the globe. And yes, it started to come down, but it's pretty hard, as anybody knows that's been in manufacturing, to just turn off a manufacturing facility, stop pulling oil out of the ground like that. There's processes that have to go through, and it's expensive to shut it down and restart it. And so there's kind of a wait and see mentality. People have continued to produce oil. However, on the consumption side, you've seen a very rapid decline, as you can see here. And so what you have is this supply and demand imbalance. There's still oil coming out of the ground, but people are using less of it. And so what you see is the stock build. The facilities to store these barrels of oil are starting to get full, and so nobody wants them now. You can see that here. So typically here we have 60 to 65 days of supply of oil available at any one time. This is spiked to almost 85 days, and it's forecasted to decline and come down, but this spike in terms of the inventory that we have is why nobody wants oil today. They'd rather have it in the future when demand comes back. So the way the contracts work is there's different months. You can take it now or you can take it 12 months later, and you can kind of see this in the price. The contracts for the next couple of months, oil is it's not worthless, but it's $15 a barrel. It's pretty low. Whereas if you get out 12 months in the future, it's $30 to $35 a barrel. So again, what you would expect to see is these over the next couple months, because of what we saw on the demand side, the forecasted demand side, there's not as much use for it now, but in the future, it's not that the market's pricing in that oil is going to be worthless forever, because nobody's going to use oil again. It's more of a supply and demand issue in the short run, and not a lot of place to put it with the storage facilities filling up. So that's it on the oil front. Hopefully that's helpful, and that's it for the update for this week. Again, hope this is helpful. If you have any questions, please let us know. We'd love to answer them there, and hope you have a good end of your week. All right, bye.